Good day everyone, my name is Erica May Ramos, and in this video we're going to discuss about loans and credit cards. For the content of this video, we have the introduction, types of loans, types of credit cards, pros and cons of loans, and pros and cons of credit card. You heard the old advice that it's always best to save, and it's true. But that's not always possible. And for those times, you might need to decide which type of financing wins in the battle between a loan versus a credit card. Both options can help you get the money you need, but under very different terms depending on your financial goals and standing. One might be a better option than the other. The biggest difference between credit cards and personal loans is that they involve different types of credit. Personal loans are installment loans in which you receive your money in a lump sum and then repay the loan in even payments over time. Credit cards are revolving credit cards, which means you can borrow money as you need it, and your payments are based on how much your outstanding balance is at a given time. Here are the key takeaways about loans and credit cards. Loans offer borrowed funds in one initial lump sum with relatively lower interest rates. They must be repaid over a finite period of time. Loans and credit card agreements can be structured with a wide variety of provisions and terms. Credit cards are a type of revolving credit that gives a borrower access to funds as long as the account remains in good standing. Credit scoring is a key factor influencing approvals and terms for both personal loans and credit cards. So both personal loans and credit cards can be unsecured and secured, which also has an influence on the credit terms. Both paying your credit card balance and repaying personal loans in a timely manner can help you build your credit score.
Types of loans. Before borrowing any money, it's important to know the type of loan that's best suited for your needs. Here are the most common types of loans and their key features. Personal loans. Personal loans can be generally used for anything you choose. Some people use them for emergency purposes, weddings, or home improvement projects. Personal loans are usually unsecured, meaning they do not require collateral. They may have fixed or variable interest rates and repayment terms of a few months to several years. Auto loans. When you buy a vehicle, an auto loan lets you borrow the price of the car minus any down payment. The vehicle serves as collateral and can be repossessed if the borrower stops making payments. Auto loan terms generally range from 36 months to 72 months, although longer loan terms are becoming more common as auto prices rise. Student loans. Student loans can help pay for college and graduate school. They are available from both the federal government and from private lenders. Federal student loans are more desirable because they offer more deferment, forbearance, forgiveness, and income-based repayment options. Student loans from private lenders, on the other hand, usually require a credit check, and each lender sets its own loan terms, interest rates, and fees. Mortgage loans. A mortgage loan covers the purchase price of a home minus any down payment. The property acts as collateral, which can be foreclosed by the lender if mortgage payments are missed. Mortgages are typically repaid over 10, 15, 20, or 30 years. Mortgages may have fixed interest rates that stay the same through the life of the loan or adjustable rates that can be changed annually by the lender. Home equity loans. A home equity loan or home equity line of credit lets you borrow up to a percentage of the equity in your home to use for any purpose. Home equity loans are installment loans. You receive a lump sum and pay it back over time, usually with 5 to 30 years, in regular monthly installments. Credit Builder Loans. A credit builder loan is designed to help those with poor credit or no credit file to improve their credit and may not require a credit check. The lender puts up the loan amount into a savings account, and then you make fixed monthly payments over 6 to 24 months. When loan is repaid, you get the money back with interest in some cases. Debt consolidation loans. A consolidation loans is a personal loan designed to pay off high interest debt such as credit cards. These loans can save you money if the interest rate is lower than that of your existing debt. Consolidating debt also simplifies the payments because it means paying just one lender instead of several. Paying off credit card debt with a loan can reduce your credit utilization ratio, improving your credit score. Debt consolidation loans can have fixed or variable interest rates and a range of repayment terms. Lastly, payday loans. One type of loan to avoid is the payday loan. These short-term loans typically charge fees equivalent to annual percentage rates of 400% or more and must be repaid in full by your next payday. Although payday loans are easy to get, they're often hard to repay on time, so borrowers renew them, leading to new fees and charges and a vicious cycle of debt. Personal loans or credit cards are better options if you need money for an emergency.
In a world where consumers are offered a dizzying assortment of credit card options, it's easy to become overwhelmed by the sheer amount of options. The truth is, you don't need to know everything there is to know about every credit cards available. All you have to do now is figure out which form of credit card would be best fit for you, and then devote your mental attention to investigating which one is the best. There are 10 different sorts of credit cards. The first one is credit cards with benefits. Reward credit cards usually give you points or cash back based on a percentage of your expenditure, and some even give you additional points for things like shopping, gas, and dining out. In addition, most rewards credit cards provide at least a few alternative ways to redeem your points, such as statement credits, gift cards, or items. This makes them a perfect credit card for ordinary spending when you know you'll be able to pay it off quickly. Next is cashback credit cards. Cashback credit cards make it simple to receive cashback or statement credits on your purchases. The manner in which rewards are distributed differs each card. Some options in this category provide a flat rate of rewards, while others provide extra points in specific categories such as dining or vacation. Some even give quarterly bonus incentives in different categories, as well as a reward rate on all non-bonus purchases. Next is the travel credit cards. Travel credit cards offer you the opportunity to earn rewards that are geared specifically towards travel. Whether that means earning flexible travel credits you can use towards any travel purchases or even points you can transfer to airline or hotel programs. Some travel credit cards also let you earn points with a specific program such as a frequent flyer program or hotel loyalty program. The next one is the balance transfer credit cards. If you have some high interest credit card debt on your hands, you may consider using a balance transfer credit card to help manage and pay down that debt. The best balance transfer cards let you secure an introductory 0% APR for a period typically between 15 and 21 months, which can give you a nice break from paying interest changes while you focus on paying down your debt. Most cards require you to pay up from balance transfer fee 3% or 5%, although there are some credit cards with no balance transfer fee. Still, even after taking the balance transfer fee into account, you could save significant sum of money on interest during your card's introductory APR offer. The next is the 0% into APR credit cards and low interest credit cards. There are also a number of credit cards that provides a 0% initial APR on purchases for a set period of time, usually up to 18 months. If you need to make a major purchase and want to pay it off over times within interest, credit cards in this area can be good send. Similarly, low interest credit cards that offer low than average rates here round not only during an initial offer period are available. The next one is the business credit cards. Business credit cards allow cardholders to keep their personal and business expenses separate while they can earn rewards on all their business spending. Interestingly enough, business credit cards can also be cashback credit cards, general rewards credit cards, travel credit cards, or even secured credit cards. You do need to have a business or incoming producing activity to quality for a business credit card. In general, the sign of a good business credit card are if help you to benefit from the everyday spending and make running your business easier. The next one is the student credit cards. Student credit cards are essential starter credit cards designed for young individuals with a little or no credit history. In other words, application standards are less severe, making approval easier. Most students' credit cards don't have annual fee, and many of them give extra incentives for good grades as well as rewards for every dollar spent. The next one is the secured credit card. Most credit cards are unsecured, which means you don't have to put anything down as security. Secured credit cards, on the other hand, require you to make a cash deposit in exchange for a small line of credits, usually for a same amount. While putting down collateral may not seem ideal, secured credit cards are the easiest type of credit cards to get approved for, so they are often helpful when you need to build credit from scratch or want to repair your credit after a financial hurdle. The next is the store credit cards. Store credit cards are offered through retail stores to let consumers charge their purchases and pay them off over time. Store credit cards are generally used within the specific store that offers them, although some store credit cards can be used within a specific family stores. And the last one is the co-branded credit cards. Co-branded credit cards are store or brand credit cards offered through traditional cards issue like Chase, Citi, or American Express. This can include airline credits that let you earn miles within a specific frequent flyer program or hotel credit card that can let you earn points within a hotel loyalty program. Some co-branded credit cards also partner with retail stores, although you can typically use them for non-store purchases as well. Generally, the rewards offered by co-brand credit cards are limited to one brand, but their rewards are solid in many cases. The value of these rewards, like free hotel nights, end up being worth more than cashbacks.
Pros of loans. Number one is flexibility and versatility. Some local loans can only be utilized for specific purposes, When you take out a car loan, for example, you can only spend the money to buy a car. Loans can be used for a variety of things, including debt consolidations and medical bill repayment. Second is interest rates are lower and borrowing limitations are larger. The interest rates for personal loans are frequently cheaper than those ranging from 6 to 8% are available to consumers with outstanding credit histories. You may potentially be eligible for a loan amount more than your credit card limit. The third is interest rates may be greater than those offered by other options. Loans do not necessarily have the lowest interest rates. This is especially for borrowers with bad credit who may be subjected to greater interest rates than those charged by credit cards. Higher payments than credit cards. Credit cards provide low monthly minimum payments and due date for paying off your balance in full. Personal loans have a higher fixed monthly payment and must be repaid before the loan period ends. Is a loan is the best option for you? A loan can be used for just about anything. Some lenders may ask what you plan to do with the money, but others will just want to be sure that you have the ability to pay it back. Though personal loans are not inexpensive, they can be a viable option in a variety of circumstances. If you need money right away to cover the bills and emergency costs or something else that needs immediate attention, you can take out personal loan. Most lenders provide online applications that allow you to learn whatever you've been approved in a minute. You could receive a funding that day or within a few business days, depending on your lenders. You can use a personal loans to cover emergencies like paying past due home payments and utilities, medical bills, funeral expenses, and unexpected car repair. So here is some cons of loans. The first is come with fees and penalties. In addition to interest rates, many lenders charge application fees and origination fees to cover the cost of processing. Likewise, a borrower may encounter penalties for making a late payment or having insufficient funds for payments. The second is lead to credit damage. Just as lenders report positive payments, history to credit varies. They also report late payments and non-payments. For that reason, borrowers who fail to make an on-time payments or who default on the loan altogether are likely to find themselves with a lower credit score. Third is result in unnecessary debt. Depending on your reasons for getting a personal loan, this type of financing can lead to unnecessary debt. Before you commit to a loan, big or small, evaluate why you are borrowing the funds and whether a personal loan is the best solution. Third is required collateral. If you don't have a high enough credit score to qualify for a secured loan, you may have to pledge assets as a collateral. When loans are not suitable, taking out loan for continuing expenses is not a good option because it may be tough to keep up with the repayments. Rather, ongoing expenses should be financed with a cash from sales, potentially with an overdraft as a backup. Loans are not very flexible. You could be paying interest or funds you're not using. You could have trouble making monthly repayments if your customers don't pay you up for monthly, causing a cash flow problems.
Good morning, sir. I'm John Macrinlania from BSBA 3U, and this is my report about pros and cons of credit card. Number 1. Most accepted method of payment. You can travel anywhere without carrying much money if you have this card. Buy on credit. You can buy anything within that limit and pay later. Make travel easy. The use of credit card in travel make them important so you can also enjoy discounts on food in restaurants. Offer safety. You don't have to carry much money if you have a credit card. Discounts and cashbacks. The advantage of credit card extends to a discount on movie tickets, online shopping, and health and wellness outlets. Credit damage. Missed credit card repayments and ongoing debts are recorded on your credit file and can impact your chances of getting a loan down the track. Credit card fraud. There are a range of fraud schemes that target credit cards. While you can compensated for illegal transaction on your account, dealing with credit card fraud can still be a time-consuming and stressful experience. Scammers could use skimming devices, phishing techniques, and other tricks to steal your credit card information and your hard-earned money. Other fees can quickly add up. Depending on your card, you could be charged fees when you miss a payment, fees if you spend past your credit limit. Overspending. When talking about the pros and cons of credit cards, this is a classic downside. Some individuals can get easily carried away with their credit card, creating a debt that is beyond their means to pay off.